Well, we've got the management of Arvind Fashions waiting by to take some questions. They posted a strong set of fourth quarter numbers. Revenue growth was led by higher growth in power brands such as US Polo, Tommy Hilfiger, and Flying Machine. Kulin Lalbhai is a vice chairman and a non-executive director at the company. He's joining us right now to take some questions. Kulin, good to have you with us here. Good morning. Thanks very much for your time.
Good morning.
So you've done very well, and the power brands, as I mentioned, have been the driver for you. Could you give us a sneak peek into what Q1 of 24 has been like so far, and what your expectations are from FY24? Many other discretionary categories, other businesses which we speak with regularly on the back of earnings, etc., have been pointing to, some sort of a slowdown. Customer overall sentiment not being all that upbeat, etc. Are you seeing any of it, and how does that, if at all, feed into your numbers for FY24, your outlook? Go on.
Let me just start with FY23. I think it was an exceptional year for us where we saw our revenues go up by around 50% and our EBITDA went up by 100%. So we doubled our EBITDA. And, consistently we have been focused on scaling up our large brands. We have divested of unprofitable businesses, and we are really driving very strong full price sell-throughs, high productivity and high turn. So I think all the efforts which we have put in showed in last year's numbers. In fact, on the market sluggishness, I would say that post-Diwali, the markets have remained a little sluggish. In fact, in Q4, also the markets were sluggish, but I think the internal efficiencies and the brands being re-energized in our case have allowed us to post very strong numbers. I think this softness in demand can continue for another quarter or so, and we expect that as Diwali approaches, the mood as well as the traction should increase in our category. Last year also, we had a high base because, after the Omicron wave, the pent-up demand had also come in, which of course creates a higher base effect. But if we remove all of that, I think a little bit of sluggishness in demand is definitely there. We as a company have multiple growth drivers, so we intend to, have a very bold plan for FY24.
Kulin, hi, morning. If sluggish demand gets you to showcase 70% EBITDA growth, then I don't know what good demand will do to the numbers, right? Because despite the environment that you described, those numbers are phenomenal, which is why I want to come to the margins specifically. For FY23, you have almost you're at double digits. At the end of fourth quarter, you're almost at 11% margin. How sustainable is this? Can it be improved, in this year? And what's the quantum of price increases you're able to push through the market?
So, we definitely expect our EBITDA to continue to improve. We have multiple reasons why that is happening. One is that while certain brands have, inherent EBITDA profiles of more than 15% post-Ind AS, certain brands for our company are still smaller and they're scaling up. So as they scale up, their profitability will significantly improve, brands such as Arrow. And we also have overall operating leverage coming through in the company. So, because of these effects, we believe that year on year, we should see at least 100 basis points improvement in our EBITDA margins. And that's kind of the plan for next year as well. As far as the product costs are concerned, go ahead.
So no, just to kind of quantify that, so you're saying margins full year, blended margins full year basis, you're aiming to get to around 13%.
More than that is our internal target, because we do believe we have a lot of reasons why operating leverage and profitability enhancement will come into our overall business.
Okay, well, Kulin, hi, good morning. What are your plans with Sephora? I mean, I'm not asking just for personal reasons, but also, for our viewers. Last time you mentioned that you're in talks to get the online license. Any progress that you've made there?
So I don't have any specific updates to give you, Sonia, except that, we continue to remain excited about how the business is currently operating. As you know, it is the leading premium beauty retailer in the country. Our stores are looking great, and we continue to add new brands and make the proposition even stronger for the consumer.
Okay, I'm also asking because there's so much competition now, right? Both online as well as offline in the beauty space, with so many new players coming in. I mean, the first mover advantage that Nykaa had, despite having all of that, they are struggling in that market. So just trying to understand from you in terms of this e-commerce space, last time you had mentioned that online will grow faster than offline. What was the revenue contribution for FY23 and what are you targeting? I think 15% of your revenues come from online currently. But how much do you plan to grow it by? And are you seeing some moderation in demand trends there as well?
Sonia, we are actually in the early 20s. We have amongst the highest online share in the category. So we have very strong online business. And yes, I think there is a little moderation in the growth. Again, I would account that more towards the base effect. Because of COVID, the base got inflated. And therefore, the year just after COVID will definitely see the impact of growth on that higher base. But I'm very convinced that the long-term potential of online, we're just starting out when it comes to the online story in India. The penetration is growing. Customers are becoming more and more comfortable with purchasing online, and apparel will become the largest segment in e-commerce overall. So the company, as far as we are concerned, we are betting heavily on what we call our omni-channel strategy. And I do believe in the years to come, the share of online in our business will stay in the 20s, if not move to the high 20s as, the market matures.
So, Kulin, to round things up, you did a top line of a little over 4,400 crores in the year that closed. You're already targeting margins of 13% plus. What about top line growth? What's the expectation with which you're working? And will it be, more volumes or stronger pricing or a mix of both?
So the next year will be volume-led growth. In fact, cotton prices have corrected. So we do not expect value growth now to be there in the business. And we have given a medium-term guidance of around 15% growth. The key drivers being we should be opening around 200 stores across all our brands next year. We expect our online channel to grow, and we've had a very high growth in new categories which we have launched. We have a very successful footwear business which is scaling up. We are also scaling up in kids wear and innerwear. So with all of those growth drivers, over the next 3 years, we do believe that 15% kind of growth is what we can achieve with very healthy profitability improvement as well.
All right. Over the next couple of years, 15% revenue growth, strong guidance for margins in FY24. You mentioned cotton prices coming off, so it'll be volume-led and new businesses are scaling up as well. Thanks very much, Kulin. Appreciate you joining in and for taking those questions and answering them. Well,